Good morning and welcome to today's Global Insight Report. I'm Nimah and over the next few minutes, we'll take a step back from the day-to-day headlines to explore the larger forces reshaping our global economy. In an era where news travels at lightning speed and markets react instantly, it's easy to get lost in the noise. But today's story is not about the fast movement, it's about the pause, a growing hesitation in global growth, a slowdown with the name we all recognize, recession. This is not just economic jargon, it's something many are beginning to feel through higher grocery bills, uncertain jobs, and businesses under pressure. Recession didn't arrive overnight, they creeping, showing signs that things are shifting. So today we're asking not just if a global recession is coming, but what it means and how we'll respond. Let's start with a quick look around the world. In the United States, indicators suggest that the pace of economic growth has moderated. Consumer spending has softened in recent months. Job creation has slowed, and inflation, while easing in some sectors, remain a concern. The Federal Reserve has increased interest rate to address inflationary pressure, which has contributed to tighter financial conditions. Some analysis warn that if this trend continues, the U.S. could face a shallow but prolonged economic downturn. In Europe, several economies are also experiencing signs of slowdown. Germany, for example, recently entered a technical recession. In the United Kingdom, inflation and rising borrowing costs have created challenges for households and businesses. Labor-related unrest in countries like France and Italy reflect ongoing economic pressure. The European Central Bank has also taken a more cautious stance, balancing inflation control with the risks of stalling growth. In Asia, China's recovery following the COVID-19 pandemic has been uneven, with domestic demand challenges in the property sector and reduced export volumes have weighed on growth. Japan continues to see modest growth, while South Korea's export-driven economy has been affected by a shift in global demand. Across the region, central banks are navigating a complex landscape of currency volatility, trade uncertainty, and changing consumer behavior. Many developing countries are facing a combination of high debt burdens, elevated food and fuel costs, and limited fiscal capacity. A stronger US dollar, partly due to a in Asia, China's recovery following the COVID-19 pandemic has been uneven, with domestic demand challenges in the property sector and reduced export volumes have weighed off growth. Japan continues to see modest growth, while South Korea's export-driven economy has been affected by a shift in global demand. Across the region, central banks are navigating a complex landscape of currency volatility for uncertainty and changing consumer behavior. Many developing countries are facing a combination of high debt burdens, elevated food and fuel costs, and limited fiscal capacity. A stronger US dollar, partly due to American monetary policy, has increased the cost of servicing foreign debt for some of these nations. In regions like Sub-Saharan Africa and parts of Latin America, governments are also grappling with inflation and fragile public finance. Although the degree of impact varies, several regions are confronting similar macroeconomic challenges. Understanding the causes behind this condition can provide insight into possible responses and outcomes. Recent global economic development are shaped by a combination of factors, some of which have been building for several years. The COVID-19 pandemic in 2020 disrupted economic activity worldwide. Government implemented large-scale fiscal and monetary measures to reduce the severity of the shock. While these efforts supported a recovery, they also created new complexities when restriction eased, demand rebounded quickly. However, supply chains were still recovering, creating imbalances that contributed to rising prices. The conflict between Russia and Ukraine again further disruption, particularly to energy and agricultural markets. This contributed to additional inflationary pressure in many parts of the world, particularly in Europe and lower-income countries that rely on import food and fuel. To manage inflation, central banks in many countries raise interest rates. The policy actions are designed to reduce demand and contain price increases, but they also tend to slow economic activity more broadly. In many countries, borrowing costs have increased, mortgage rates are higher, some businesses have postponed investment plans, and households are facing increased debt servicing expenses. In sectors such as technology, several large companies have announced layoff and cost-cutting measures. Small and medium enterprises, especially those with limited access to credit, might be more affected by higher interest rates and slower demand. In lower income households, cost of living pressure have led to a reduction in discretionary spending. For developing economies, as small conditions have become more challenging, a stronger dollar has raised the cost of imports and external debt, while capital outflows have added pressure to exchange rate in some cases. Countries in Southeast Asia, including Indonesia and Vietnam, have maintained stable growth supported by domestic demand and supply chain diversification. In Latin America, some economies have benefited from high global commodity prices. While in Africa, the rise of digital entrepreneurship has supported small-scale innovation and service delivery. In addition, sectors like the long-term structural shifts such as renewable energy, electric mobility, and digital infrastructure have continued to attract investment. These areas may offer future growth opportunities as the global economic transition toward sustainability and digitalization. While it is too early to make definite conclusion, most economists suggest that global growth is likely to remain subdued in the near term. The outlook will depend on multiple factors, including monetary policy, geopolitical development, supply chain adjustment, and consumer and investor confidence. Periods of slower growth often bring both risks and opportunities. Monitoring these changes and responding with evidence-based strategies may help reduce economic vulnerability and promote more balanced development in the long run. Periods of economic slowdown, when challenging, also create space for reflection and reflection as the global economy adjusts to tighter financial conditions, shifting trade patterns, and evolving consumer behavior. Decision makers across sectors are evaluating strategies not only to manage risk but also to identify new paths for sustainable growth. The diversity of regional responses, whether through investment in digital innovation, supply chain management, or green technologies demonstrates that reliance is possible even under pressure. In the coming months, continued collaboration between governments, business, and communities will be essential to support recovery and stability. That's all for today. Global Insight Report. I am Zahrotun and we'll be soon.